If you've been saving up for a down payment on a home, you might be wondering what the maximum home price you can comfortably afford. Now today I'm going to cover what that is. The median household income is about 50K, so I'm going to use this as an example to figure out how much the median income household family can afford. Basically, for a median household income, you can just multiply it by 5 and you'll get 250K, and that is the mortgage that you can afford. Most of these calculations, you're just working backwards from how much income you have. Basically, you look at how much income you have set a certain ratio, and that is the amount that you should be able to pay into your mortgage every month. A typical set of criteria for a certain lender will actually make the calculation very, very easy. For example, if you have someone that has a 700 credit score or above, you're going to get an interest rate of about 4%. This is for 2016. If the interest rate changes in the future, you just gotta modify a little bit and then you can do a simple calculation as well. It just won't be 5. It assumes you're getting a 30-year fixed mortgage and that you're paying 20% down payment on it. So if you have a typical set of criteria right here, you're pretty good with your credit but not super excellent, but you've been saving up your down payment and you have roughly 20%. This is the way to figure out how much home you can afford. You take your income, I'm just gonna use 50,000 because that's a median US household income. You multiply it by 5. That's really easy. You can just do that in your head and you get 250K. This is roughly the number that you'll get if you do all the math over here using the long way. So you can just multiply by 5 and then you get your mortgage, 250K of mortgage. That's just how much you owe the bank. But on top of that, you probably paid the down payment. So then this is about 80% of it. So we gotta back calculate about 20%. 20% of this whole thing is $62,500. This is the amount that you need in order to buy the house with the down payment. And you need maybe about $6,000 in closing costs or so for something like this. Just add 250K to 62K, and 312K is the home price that you can afford if you have a $50,000 income. Now in the Bay Area of California, you can't really buy much with 312K. You can't even buy an apartment. You might be able to buy like a manufactured home or something like that with this amount. So if you make this much in the Bay Area, it's gonna be really hard for you to buy any decent place. But if you make double this at 100K, then you can afford something double this, which is 624K. Still, in the Bay Area of California, the houses around here starts at 500K and they go all the way up to millions. But even if you make twice this amount, you can only afford 624K. The houses in the Bay Area start around 500K. So if you have a budget of around 624K, you can still only buy like a very basic introductory home. I know this looks a little simple, but I'm gonna jump one level deeper to show you that this number is actually pretty correct for this set of criteria over here. Now let's start with the back-end ratio. The bank does not really want you to spend all your money on the mortgage because you need some to live on, you need some to pay car payments, credit card payments, go on vacation, etc. So they set this ratio at 28%. So if you make $50,000 a year, 28% of that is $14,000. If you divide this by 12, you get $1,166, which is the amount they want you to use on a mortgage, the maximum amount. Now this maximum amount is not set in stone and you can push it a little harder. But if you push it a little harder, it's gonna be harder and harder to get a mortgage. You need a credit score of 700 in order to get an interest rate of 4%. And if you have something higher, you're still gonna get around 4%. As you can see here, the worse a credit score you get, the higher interest rate gets. Now, if you're interested in improving your credit score, I have a whole bunch of other videos in my advanced finance playlists that you can look over in order to improve your credit score. Now, let's just say you have a credit score of 700 and above, and you get an interest rate of 4%. For a mortgage of $250,000, you can see here, the payment is $1,194. This is strangely very close to how much you can afford, so it does work out. You can see here, for a person with a worse credit score, they have to pay more for the same $250,000 mortgage. Of course, I didn't add the HOA costs and the property taxes. If you want something down to the dollar, yes, you can go and figure that out, but this is a great way. You just go $50,000 multiplied by 5. If you know your credit score is in this range, and also that you know you're saving up 20% for the down payment, it's a great way to do mental calculation of how much you can actually afford a home. It's important to know that even though you're getting a pretty good rate at 4% here, by the time you're done paying your mortgage, you're gonna be paying about $180,000 on top of this $250,000 mortgage by the time you're done. So it's quite hefty. And if you have a worse credit score, you scoot over here, you're gonna end up paying about roughly 100%, or you borrow 250K, you have to pay back 250K, and on top of that, you gotta pay another 250K in interest. I do have to note that taking 28% of your take-home pay in order to pay your mortgage, it's quite burdensome. It's gonna feel pretty heavy in the beginning, but it gets better and better because inflation goes up, your income goes up. If your career path gets better and better, you're gonna make more and more money. Therefore, as the years goes past, your fixed payment per month is gonna stay the same. So it's gonna feel smaller and smaller as the years goes on. So in this sense, it might be okay to stretch a little bit because it's gonna feel less impactful in the future because the payment will seem smaller and smaller compared to your total income. The other ratio that the banks are concerned with is the front end ratio. They don't want you to have too many debts so that you can't afford to pay the mortgage. That is set around 36% of your total income. So if you multiply this out, it's about 18,000 divided by 12. It's about $1,500 a month. Now this is the amount that you can afford to pay the mortgage and all your other debt obligations. They don't want you to exceed this. Therefore, you can have about $334 worth of other kinds of debts, and then you'll still have $1,166 left over for your mortgage payments. So if you have debt payments under $334, your front end ratio is not gonna affect your mortgage. Your minimum credit payment that you need to pay, your student loans, your child support if you have any of those, and car payments, you add all those up, every single month you have to pay this much. Those are your obligations, and it must not exceed $334. This front end ratio, it's also not set in stone. You can push it a little harder. 43%, 50% is probably the most you would ever want to go, and this is super aggressive already. You don't want to push it too hard because it create an extra burden on yourself. It will create a lot of stress if you're trying to make ends meet to make the mortgage payment. So I hope that was useful. If you have a different income, for example, twice as much, you can just scale the final number by twice as much. If you have a different credit score, then you would have to take the monthly payment for that credit score and scale that accordingly as well. This is Beat the Bush. Don't forget to give me a like over here, comment down below, let me know if this helps, and don't forget to subscribe over here. Thanks for watching.